I'm Josh, I'm a qualified actuary with over 11 years of investment experience at one of the world's largest asset owners, which currently manages over $163 billion. Here's my brutally honest investment advice based on my experience during that time. 1. It is possible to outperform the market. Now, for those of you who have studied investment theory, you will probably have come across the efficient markets hypothesis. And what the efficient markets hypothesis says in its strong form is that all information is known by all market participants at any one point in time. Therefore, the market price takes into account all that information, and it is impossible to outperform the market, i.e. know something that the market doesn't know. However, any experienced market practitioner will know that this is definitely not true. I spent some of my time while I was working traveling around different regions, and it was clear that what was going on in China wasn't known by the people who were investing in Chile, and that was typically not known by the people investing in New York. So I would say that information is not evenly distributed amongst market participants. Therefore, it is possible to find market participants who know something other investors don't and are able to outperform the market. Indeed, it was my full-time job for the first 6 years of my career to find these investment strategies and these investors who could sustainably outperform the market, and we definitely found them. However, just because it's possible doesn't mean it's easy, and I would say it's exceptionally hard to outperform the market sustainably. And typically any strategy that is able to outperform the market consistently is not available to retail investors. So for any investor who is not a professional investor, it's probably best to stick to passive indices or just tracking the market. It's extremely difficult to outperform net of all fees and costs, and typically retail investors aren't able to negotiate these fees, or they tend to pay quite high fees just because they've got relatively small investment amounts compared to professional investors or pension schemes or other asset owners. So if you're a retail investor, stick to passive. That leads me on to number 2, which is costs and fees are extremely important. So investment returns are variable, which means that you might not get back what you put in. Over the long run, you should generate positive returns. Otherwise, the investment would be a particularly bad investment. However, that is not guaranteed in any sense. But when you typically invest, you typically have to pay some costs or fees that are associated with that investment. So that might be an annual management charge levied by an asset management firm, or you might pay transaction costs, for example. And these costs are not variable, they're typically fixed, which means that one of the best ways you can improve your future expected outcomes is to reduce fixed costs. Fees in particular can dramatically cut into your future investment profits. So let's consider an example where you've got 2 fund managers that invest in the S&P 500. One manager charges 2% per annum management charge, and the other charges 0.5% per annum annual management charge. So if the S&P 500 at the end of the year does 7%, your net of fee return in one manager is 5%, i.e. you've taken off the 2% annual management charge and you're only left with 5%. But for the other manager that only charges 0.5%, you're left with 6.5% return at the end of that year. And typically you're not investing for one single year, you're typically investing over multiple years, even decades. And these charges can really add up over that long time frame, because any charge you're taking off at the end of the year is basically taking money away from you that could be compounded in the future. So that money is not going to contribute towards your compound gains in the future. This means that fixed costs can become very large over long time periods. So it's so important to look at the costs of your investments and get them as low as possible. Now, I do appreciate some investments might be higher cost for a reason. They might be higher quality investments, they might have a higher expected return, but that's still variable. There's still a degree of uncertainty around that future higher expected return. So all else equal, you should focus on keeping costs down. Point number 3 is that loss aversion is real. So investment losses are extremely painful, and this is called loss aversion. So the idea that humans tend to feel the pain from losses more than they feel the joy from gains. They tend to prefer not to lose things more than they prefer to gain things, and that's called loss aversion. And because of that, we tend to make very bad decisions when we're experiencing big drawdowns. So think, for example, if you invested in the S&P in January 2020, and then a few months later your investment was worth half, or it was down 50% versus what you initially put in, you're going to be feeling pretty bad at that point. And believe me, you might struggle to imagine that now, but if you're in that situation, it hurts, and I've definitely been there. And the problem with this is that typically investors make bad decisions. They get out at the worst possible point to try and stop that pain, but often the best thing to do is to stay invested, run the course, and benefit from the market returning to its average expected return over the long term. So for example, if you stayed in from January 2020 to now into the S&P, you would be up over 80%. So worth sticking around for the long run and not panic selling at the bottom because of loss aversion. Point number 4 is that markets tend to mean revert. So markets are very volatile. They go up and down every day. There's a lot of noise, there's a lot of randomness. What you tend to find is that markets exhibit a phenomena called mean reversion, which means if they've been going up a lot, they tend to correct and come back down a lot and tend to operate around some long term. So for the S&P, for example, people talk about this being like 7% long term annual returns, but that means sometimes it's up, 20, like it is this year, up 20 something percent, 27% I think, and then some years it's only up 3%. But over the long run you should average decent return, but to achieve that return you have to be invested for the long run. So what does this mean? It means that if you're experiencing prices going down for a long time, it's likely that they'll come back up, and if you've experienced prices going up for a long time, it's likely that they'll correct at any one point. The problem is it's really hard to predict when that will happen, and as we've seen in the S&P, bull markets tend to run for about 10 years or so you could be waiting a long time for that correction. So another interesting phenomena is they tend to increase in value very slowly and decrease in value very quickly. So you tend to have years and years and years of price increases, but this can be followed by a very quick price decrease. And we saw that in the pandemic and COVID-19, how quickly prices fell. And people tend to call this up the stairs and down the elevator. So prices tend to go up quite steadily and then they drop very quickly. So even though mean reversion is a thing, it's not your typical nice smooth kind of sine wave. It tends to be quite jagged, it's lumpy, and up markets can last a lot longer than down markets. Point number 5 is that the market tends to dramatically underappreciate extreme downside risk or tail events. Now I experienced my first tail event in the COVID-19 pandemic, and the S&P dropped dramatically in a matter of days. And prior to that there was the Lehman crisis in 2008, or the banking crisis. Prior to that there was the dot-com bust. Prior to that there was the Asia crisis. Prior to that there was Black Monday. Basically the market does tend to correct dramatically and quickly once every 10 years roughly, and unless you've lived a market cycle you might not fully appreciate that unless you've read your financial history. And I remember actually in the lead up to the COVID-19 pandemic, we obviously hadn't had a down year we obviously hadn't had a market crisis for a very long time, and the rhetoric starts to become, oh, this is the great moderation, oh, this time it's different, oh, this is the new normal, we're lower for longer and market volatility is just never going to come back. There are some investors that make huge amounts of money from predicting or positioning ahead of these market crashes, so tail hedging managers. And my role going into the COVID-19 pandemic was to position our portfolios for a tail event, and I experienced firsthand exactly how hard it is to put these investments forward when everyone thinks that we're going into this great moderation and nothing's going to happen and there's never going to be any sort of tail event. So yeah, luckily I was vindicated in the end, but I've definitely experienced how hard it is to position against the market, especially when they think nothing like this is ever going to happen. One of the most famous investors in this area is Nassim Taleb. He obviously wrote the book The Black Swan, which is all about this, and his whole argument is that the market completely underappreciates these risks, these black swans, and fails to price them in effectively. And he actually supports a hedge fund called Universa, which is a tail hedging fund which profits exactly from this sort of downside risk. It's a tail hedging fund. So point number 6 is that your investments will impact the real world. So it's clear that the real world impacts your investments. That's why we watch the news all the time. That's why we want to understand geopolitical risk, because something like, I'm going to talk about the COVID-19 pandemic again, something exogenous to the market, i.e. a pandemic, can dramatically impact the market and therefore your investments. So I think that bit is fairly intuitive. However, the flip side of that is your investments actually directly impact the real world as well. There's a reflexivity, and George Soros made this famous, the idea that the real world impacts your portfolio and your portfolio impacts the real world, or the real world impacts your investments and your investments impact the real world. Lots of people and a lot of investment theory actually completely ignores the fact that what we invest in has a tangible impact in the real world. And I think that can be largely due to the fact that we have this market of derivatives now, of side bets, where you can just invest in anything that doesn't actually have any tangible real world connection. But if you take investing back to basics and you're providing primary capital to companies or sovereigns or the mortgage market, the consumer lending market, your capital is having a direct real world impact. I think the reason lots of people have ignored this up until now is because that impact scales with the size of your capital, right? So if I am a small investor and I have £100 to invest in Apple stock and I go and buy that Apple stock, my £100 in Apple is not going to move the dial in a $1 trillion market cap company, but it does have an impact. If I'm one of the largest asset owners in the world, so the Japanese pension investment fund that's, I think it's over 2 trillion now, anything I do is going to pretty dramatically impact the real world. So I have to be really conscious about that. So at one end of the spectrum, you've got an individual investor with not much capital trying to buy Apple stock, not really going to move the dial. On the other end of the spectrum, you've got one of the largest asset owners in the world, one of the largest pots of money in the world, and and anything they do is going to dramatically impact the real world. Therefore, it is worth being conscious when you're investing about how your investment might impact the real world, and therefore, through a feedback loop, impact your portfolio. So there we have it. There were my 6 key learnings from 11 years of working in the investment industry. I hope you found this useful. If you want to hear more from me, don't forget to check out this video here. Thanks.